Hello, and thanks for joining us today for this week's investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So let's kick things off with returns from last week, as well as the year-to-date returns for the major indices. So last week saw a bit of corrective action, especially for growth stocks. International markets and value stocks, they had positive performance last week. Now, weighing on those domestic growth stocks was interest rates. We can see that bonds were down last week and they're down year to date, and that implies that rates have moved higher, and that rate move is directly influenced by the strength in energy commodities, which also had another strong week last week. Now, the economic fundamentals, they do continue to remain intact. So last week, jobless claims plunged to their lowest level of the cycle. And you would typically see rising claims if we were hurtling towards a recession, but that's just not the case today. You would also expect earnings to begin weakening, but instead, the Q2 earnings season is looking quite strong so far. Now, this chart from FactSet shows that of the S&P 500 companies that have thus far reported, 86% of them have reported a positive earnings surprise, and that's a very strong reading in historical context. But the interesting piece is that those companies are not being rewarded for beating. Thus far, the companies that have reported an earnings beat have seen their stocks fall negative 0.3% on average. Now, the companies that miss are seeing a 4% correction on their announcement, so much worse. But the takeaway is that there's a lot of earnings optimism already priced into share prices right now, and it's therefore much more difficult to impress market participants. Now, as mentioned before, investors are also dealing with rising interest rates. So, this chart here shows that the correlation of the stock market to bond yields is now negative, and we can see that in the bottom clip of this chart. And that implies that higher yields have meant lower stock prices. Now, that isn't always the case, but a negative stock and bond yield relationship does tend to occur when investors are more worried about inflation than they are about economic growth. Now, volatile energy prices and higher yields are becoming a market headwind, and the calendar itself is also turning to a headwind. So, this chart shows each 2 month combination of historical market returns. That red bar is August and September, and it implies the next 2 months have been the most challenging for investors historically. So we do have some reasons to expect volatility until the weather starts to cool down here this year. Now, currently, we do expect the market to resume an uptrend later in the fall, but it's likely that we're going to need to see a little more multiple contraction before we get there. In other words, stocks need to get a little bit cheaper. So this chart in the bottom clip is just showing the price to earnings ratio for the S&P 500. And note that it remains quite stretched. So the stock market is far from cheap despite the strong earnings growth we've seen this year. Now, the good news is that if the earnings continue to come through in Q2 and beyond, the market can get cheaper without needing to endure a bear market. So, wrapping it all up, this continues to be a year for the diversified portfolios. Growth stocks have been relatively weak, but value, small caps, and international markets have performed admirably. Economic growth remains intact and earnings have been strong. Unfortunately, a lot of good news on earnings is likely already priced into their share prices. That's why companies beating estimates are not being rewarded to the extent that they typically are. We'd expect a little more multiple contraction over the next few months, owing to strong earnings but lackluster share prices. And that could set us up for the next leg higher for the bull market here beginning in the fall. So that's what we have for you this week. And as always, I want to thank you for joining and wish you a great week ahead.